of history, looking back about how the sector's performed since the market peak in August last year. So market down about 6%. Generally across the sector, stocks have performed well. Notable exceptions there. APA off. I think that's because obviously the takeover coming off the boil. Sydney, it's had those risks that I've talked about that I'll speak about a little bit later that I think will over time dissipate, and that'll cause the stock to go up. Bingo, new stock under my coverage. Darty acquisition, ACCC looks, it's uncertain about whether they'll actually get that through, and they've raised the capital for it. Plus, you've got resi construction exposure. So that's off a bit. And then the surprising one, Cleanaway. Although looking back, Cleanaway typically does surge very nicely at the result and after it. So, if we look back in August, that's probably when they would have actually had that nice little spike. Macro context about how these things have performed. Just wanted to throw out there bond rates and inflation expectations. So obviously the lower interest rates have really helped support the sector. Those lower interest rates flow through into lower debt costs upon refinancings and new debt being raised. It also helps out on discount rates, but I really want to point out this is not a free kick for the sector. The lower interest rates are being driven, I think, a lot by lower inflation expectations. So there's you can get market implied forward CPI expectations out of the CPI swap market, and that's the chart there on the right. For a long time, long run average inflation expectations have been at that sort of midpoint of that RBA target band, 2 to 3%. You can see how it's really dropped off. You might look at it and just go, well, who really cares? I mean, that's like, 20, 30 basis points. But in a low discount rate world and in stocks that are, don't have enormous amounts of revenue growth, lopping that amount of revenue growth off the top impacts distribution growth, and it really does slide through. So it does actually have a reasonable amount of impact. My stock coverage there, going into reporting season, generally don't expect any major disasters. You look at the energy infrastructure stocks, APA take-or-pay contracts, the regulated utilities protected mostly by the regulatory decisions which run through to 2020 fixed revenue streams, so they're pretty protected. On the transport infrastructure, patronage risk, but a lot of those have actually reported at least volume numbers. Atlas, we already know what the total revenue numbers are going to be for their assets, so pretty good on that front. The greatest risk really rests with the non-infrastructure names just because of that increased level of revenue uncertainty. Look, I've put together a whole bunch of notes on each of these different stocks that are in this pack. I'm not going to go through it this morning. I'll flick the slide pack around, but what I want to hit on is those stocks that I think are the best value with the lowest risk going into reporting season. Those that are probably higher risk but potentially could move the most in reporting season, and those which I think are probably the best sources of funding. So just in terms of best value, first up, Sydney Airport. We've talked about this before, but I think there's like three sort of overhangs on this stock. First up, traffic growth slowing. I quantify that already in my target price because I've got a slowing traffic growth outlook, so that's already built into our numbers. Secondly, Productivity Commission review of economic regulation at airports. Draft report due out tomorrow, so we will know what they've got to say. Obviously, that's just the PC's report. The government can come up with their own decisions coming out of that. And finally, the distribution growth profile going into the tax-paying period early next decade. To be quite frank, I think we'll find out about that at the end of this month with the result too, because they'll provide first-time FY19 distribution guidance, and from that they have to talk about the glide path into that tax-paying period. I used to have a below consensus estimate on this one because of that glide path theory. I notice a number of brokers are now coming out saying exactly the same thing, so I may no longer be below consensus on it. The other one is Cleanaway. Stock's come off a little bit just recently. Expecting some very strong growth to come through this year. I'm sort of targeting for FY19 sort of 38% EBITDA growth. I'm about 2 to 3% ahead of consensus on this one. I think they're being what they should be, is under-promising and on the hope of over-delivering. Growth there coming from the Tox acquisition, the synergies coming out of that, margins coming through from major contracts that they've won, and just underlying organic growth really coming through the business. So I think there's a reasonable amount of upside there. And always remember, seems to happen time and time again. Stock reports, share price goes up. I think people get increased degree of confidence on the stock because there's really not much visibility between reporting dates. And then Vic and his team get on the road talking to fund managers. And that month after the result, stock really does always seem to perform very strongly. So they're my two in terms of best value for lowest risk. The two that could go up the most, First up, Bingo, regulatory decision, ACCC decision due on the 21st of February to do with the Darty acquisition. If that gets approved, stock goes up over 32 cents over my $2.37 target. If it doesn't get approved, the stock's worth $2.37. So my numbers effectively bake in a no approval scenario. Still getting 15 to 20% EBITDA growth this year, and you'll get even more than that in the following year. So it's still got a lot of growth. My numbers don't factor in any capital management initiative coming from giving back some of that $425 million of capital that they raised last year to part fund that acquisition. So I think that's an interesting one to look at. Key risk there is obviously the ACCC decision plus that resi construction exposure. ERM Power is the other one. ERM Power, two key pieces of information will come out the result. First up will be the gross margin. This business is somewhat of a black box in terms of just that gross margin number. It can be, they've told the market anywhere between $4 and $5.50 per megawatt hour. They're targeting $4.75. That's where I've set my numbers. By the time we get through the result, we're sort of 2/3 of the way through the most volatile quarter of the year in terms of the electricity market. So should have a better read on that one. But the thing that I'm really watching out for is the dividend. They exited the US business last year. That was hemorrhaging losses to the tune of sort of 7 to 8 cents per share. Without having to support that, I think the minimum dividend can go from a minimum of 7 to minimum 14 cents. So that's what you got there in my numbers, that 9% yield. Can't see why that actually can't feed through other than that gross margin turning around, moving around. If that's the case, you're getting just the current share price, that 9%, grosses up to closer to 13%, but I think that year will contract if they actually do come through with that sort of number. So I think that's another one to watch. In terms of funding sources, I hate to say it, APA. I think that one has just got a little bit too hot at the moment. I'm skeptic in terms of whether there'll be any more takeover activity coming out or past the Chong Kong sort of takeover bid that got blocked. My logic is that APA has been listed since 2001, had an open register for a long time, never had any takeover happening around it until Chong Kong came along. $11 was a very big number. If you take the current share price, put a 20 to 30% takeover premium on that, you are well beyond where the $11 number is. So I just don't believe that anyone's going to be sort of punting at that level. Chong Kong, big capital it needs to invest and low cost of capital. I just don't think there's anyone that can actually sort of beat that sort of number. So I think that's one that you could look at actually buying into. Put a report out overnight, target come back to $8.40. And a lot of that was to do with that CPI expectation. They got long-term fixed rate debt, doesn't get the benefit of the lower interest rates, but their revenues are CPI pegged. So a lot of slowing CPI actually does hit their top line, their revenue growth, etc. So that's one to me. The other one is Spark Infrastructure. Now I think this is the one that's got a bit of a move on because people are thinking that Chong Kong is going to have a crack at Spark. That certainly used to be my base case. It's not anymore. The FIRB, they had a presentation last year by their chairman. They basically said for electricity transmission and distribution assets, they want to have a degree of domestic ownership. Chong Kong doesn't want to partner with anyone. They already do partner with SKI within these assets. They want to get rid of them if they were going to take it over. The other thing is that I was talking to the Spark CEO. He actually said that when they were bidding for the New South Wales privatisation assets, the FIRB actually said you do need to have domestic content within the ownership structure of these businesses. So I think that blocks it. I think that causes Spark Infrastructure to have it doesn't deserve to have the takeover premium in it. Stock's trading on about 1.41 EV to asset base at the moment. AusNet Services is more like 1.27 times, a lot better value. So they're the two that really stand to me. The other one is Horizon. Regulatory decision is going to cause earnings to go backwards, dividends to go backwards. And I've really got doubts about the ability to contract up their coal haulage contracts that are coming up for renewal at current prices. So I haven't sort of pointed that one out as really as compelling, but certainly one to think about also.